just ask. You can start. Okay. So welcome to all the participants here. We welcome to this RMI Reinsurance course. Today we have a very elite professor, Professor Pratik Priyadarshi, who is the Program Coordinator, PGPX, Associate Professor of Insurance and Risk Management, BIMTech. He is a general insurance professional of the direct recruits batch of United India Insurance Company of 1989 batch. He has a vintage of over 30 years in the insurance industry. He has varied experience in different positions in underwriting, product development, business development, and risk management in both public sector and private sector insurance companies. He has served at various positions in United India Insurance Company, Tata AIG, IFCO Tokyo, L&T Insurance. With post-graduation from Delhi University and a PGDM from IGNOU, he has been actively involved in consultancy work, training, and advisory functions related to activities in general insurance industry. He is also a member of the Insurance Institute of India and also involved in imparting knowledge by virtue of being visiting faculty at B schools and other educational institutes in Delhi NCR. He has been a moderator, panelist, and a participant in many of the international and national conferences. So from the desk of RMI, we welcome sir, and we hand over the proceedings to you. Thank you so much.
Thank you very much.
In case Shyam missed it, he is also the council member of RMI.
Yes, he is very own.
Absolutely. Right. Thank you very much, Shyam, and of course, Rakeshji. The association with Insurance Times for me goes back as early as 1989. In fact, I remember one time having sent you the photograph also of that particular edition that wherein I had put in a letter to the editor also.
Yes.
RMAI has been doing a human's job in this particular field, and honestly, I'm delighted and I'm privileged to be a part of the entire setup. From that perspective, it'll be an honor and a pleasure to explain certain basics of reinsurance, which is this, which the topic is all about today. And my intention is to make sure that you get interested in the subject matter so that more and further and deeper information can be sought by you. We all know that insurance is a dry subject. I mean, at least it was dry, till we came into the picture. And when I say we, I mean the RMAI. We have tried to make this not only an interesting subject, but a household name as such, because at the end of the day, insurance is what is needed by each one of us. Whether it is a case of health insurance, whether it is a case of home insurance, whether it is a case of liability insurance, believe me, har kadam pe, har samay, every time you will need some policy of insurance to help and support you. With this background, I will just take you straight to my presentation. Can you all see my screen?
Yeah, we can see.
Excellent, sir. So, in fact, if you notice, I have used the word collated, and the simple reason that I have used the word collated is because of the fact that I have tried to catch up and accumulate things from different books, different articles, magazines, and different presentations, so that I give you a comprehensive topic on this. And therefore, because most of these things are not mine, I possibly could not have used by saying that this was created by me. Therefore, the usage of the term collated. And of course, that is my email ID in case somebody is interested in getting in touch with us at any given moment of time. Good to see that at least I have one window of a camera on. Reshmi Roy, good to see you, and thank you very much for switching on your camera, because many a times one feels bad speaking to the walls, and from that perspective, fantastic. One of the participants has shown the way. I hope the others follow soon. Before I begin, I would like to bring out certain caveats. First and foremost, I encourage and I welcome questions during the session. So if you have a question, if you have a query, please jot it down. The moment we are changing the slides, that would be the ideal time for you to ask me questions. However, if you are comfortable, we can have the Q&A session at the end of the entire session as well. I leave that to you at your discretion and convenience, because we'll have this session for 90 odd minutes, then we'll take a break for 10-15 minutes, and then again we'll continue for the next 90 minutes. So Whether you like it or not, you are stuck with me for the next 185 minutes. And I hope that you bear with me on this particular point. So what exactly is reinsurance? This is, I remember when I was a child, and particularly, and I come from a small place in Bihar called Muzaffarpur, So early 70s, when we had this threat of war, 1971 war, we used to have blackouts, the siren used to go off, and then suddenly, everything was out. And I remember my mother used to, tell us, "Jaldi so jao, dushman aa jayega." And we used to be scared, so much scared that when I came to the boarding school sometime in 1976, and incidentally, my boarding school was in Asansol, St. Vincent's, one of the Christian Brothers schools. Initial 2-3 nights, I used to have, nightmares, just recollecting that particular thought, ki dushman aa jayega. Now, what had happened for me was that this was a situation which was created, blown out of proportions. Similar is the case with reinsurance. Hawa bana diya hai isko. Reinsurance is not so difficult that people do not want to work on it. Reinsurance is one of the better areas, those areas where you can actually provide support to the insurance companies and to innumerable number of clients. That is what insurance is all about. Therefore, when we say reinsurance, I simply mean that it is insurance for and of the insurance companies. Sounds very simple, I mean, insurance, all of us know that the entire process of insurance goes on, and therefore, if that insurance process is repeated, meaning thereby that the insurance process is replicated by some other organization doing the same insurance process, we say that a reinsurance has happened. Meaning thereby, it is a means by which an insurance company can protect itself from risks. And let us not forget that the insurance company is protecting us from the risks, So it's like a double whammy kind of a thing, And we should be using the correct terminologies when we talk about reinsurance as such, and therefore the usage of the term called cedent. So the company which requests for the cover, meaning thereby an insurance company which is there, let's say Tata AIG. So Tata AIG wants to have a reinsurance cover with AIG. I mean, of course, they are the same group, so it's always convenient to have an RI cover with their own group. So Tata AIG becomes the cedent and AIG is the ceded. That is the terminology that we use for reinsurance. So the reason why I'm making you familiar with these two terms right now is that during the session, we will be using terms like cedent and the ceded. So we should be absolutely clear when we say who or what is a cedent and who or what is a ceded. How do I go to the second? How do I change this? Okay, this way, yeah. Reinsurance is also a means by which an insurance company can protect itself with other insurance companies. Other insurance companies, I am not clear. It is an insurance company that protects itself with other insurance companies, meaning can we have two insurance companies protecting against each other because of their reinsurance arrangements? That is exactly what I'm talking about. So we have a Tata AIG at one place, and we also have an IFCO Tokyo another place. Both of them have their own reinsurance arrangements, meaning thereby that both of the insurance companies take precautions not to have a conflicting situation. And how? Because both of them have their own independent reinsurance programs. Another term that you should be familiar with is a term called retrocession. So I have an insurance company. I get it insured with a reinsurance company. So two stages. First, I'm the client. I go to an insurance company. Insurance company issues me a cover. The insurance company goes to a reinsurance company and gets a cover. Now, what if a reinsurance company also went to another reinsurance company? 3 stages. And this can go on. So when we use the term called retrocession, it means reinsurance of insurance. We will not be going into the details of retrocession for the simple reason that it's a complicated process even by standards of normal insurance. And you and I probably would never get an opportunity in our lifetime to go into retrocession. However, the terminology when we say, okay, this is a retrocession process, okay, then of course we say that risk transfer, originally. So typically, in fact, if I can show you that, yeah, this is the particular slide that I wanted to share with you. Insurance is all about an insured and an insurer, and you have a policy terms and conditions in between. Whereas a reinsurance is all about insurer oblique the reinsured. So in an insurance company, the client is the insured. For a reinsurance company, the insurance company is the client. Therefore, he is the reinsured. This is the basic difference between insurance and reinsurance. You may be interested in knowing that we do not have a reinsurance policy per se. We use the term RI slip. We call it reinsurance slip or reinsurance terms and conditions. And of course, during the session, I will tell you as to why the concept of an RI slip or an RI terms and condition has come out and not an RI policy as such. So let us begin with history of reinsurance. I'm more than sure you people are aware as to how and why insurance came into the picture. The history is not very long in the sense that it has all developed in the last 500, 700, 800 years as such. And why? Because that was the time when the sense of adventure forced people to travel out. And how did they travel out? Mostly, by and large, by ships. In fact, I'm told that there are certain expeditions which were sponsored by the royal families. The travel of Columbus when he discovered America in 1492. It was sponsored by one of the royal families. But why do we involve the royal families? Because they were the ones who had the money. They were the ones who had the revenues, the currency, to sponsor or to support such long voyages. Naturally, they also wanted some sort of a support, some sort of a backup kind of a thing that, okay, what if the ship was lost on the seas? They would lose their entire money. And that is how it started off with the marine reinsurance that was in 1370. Now, honestly speaking, why do we talk about history? Whether it is the history of the nation, whether it is the history of a subject, whatever it is, the idea is that to give you a background as to why this entire thing has come right now. You will know the perspective that this is the background in which we are talking about. So, for instance, we know that marine was the important aspect. Why? Because most of the ships were going out. Therefore, naturally, they wanted some sort of a support mechanism that if the ship was lost on the seas, who would pay for it? Therefore, marine reinsurance. The first fire reinsurance contract was in 1821. Now, for some of you or for any one of you who was not aware of it, this entire fire insurance came into being only after the fire of London in 1680s, and that is where the concept of a fire insurance company started coming up, with each fire insurance company having their own fire stations. So what they used to do was that if they insure a house, they would put a metal tag on the home itself, the building, so that everyone knew that this particular building was insured by ABC Fire Insurance Company. There was a probability that in the same locality, 4 or 5 houses could be insured by one insurance company, and the balance houses were insured by the second company. It so happened that in case there was a fire in, let's say, A company, the fire brigade of B company would not go and douse that fire. Why? Because it was not their client, not their business. Now, because of this, a lot of lives were lost, a lot of property was damaged, and gradually and slowly, in the 18th century, somewhere around 1760s, or was it 1770s? That was the period when it was decided with consent from all the fire insurance companies that a common fire station would be created so that whichever insurance company had covered the building, the fire insurance would cater to it. I mean, these were the nuances at that time which were not known to many of us. And that is why the history is important. So marine reinsurance started in 1370. Fire first reinsurance contract was in 1821. And of course, there are certain specialized reinsurers which we are aware of it and they are still working today. For instance, Cologne Re is there. It started off in 1852. Swiss Re, 1863. Munich Re. Swiss Re and Munich Re are the two largest reinsurers in the world today. I've just named a few of them because there are at least 50 other names that I can give you. 50. We in India are dealing probably with about 24 or probably 25 odd reinsurance companies as on date, because the latest government and IRDA guidelines have permitted the foreign reinsurance companies to open their offices in India. And India is the biggest market in the world right now, for whatever field you talk about it, whether it is for COVID vaccines, whether it is for insurance, whether it is for automobiles, clothes, you name it, garment industry, anything, we are the largest market. Therefore, the focus and importance on India as such. Of course, when if the world was moving so fast on the reinsurance segment, we Indians could not have been far behind there. And we started off with a India Reinsurance Corporation, which was formed in 1956. And then, of course, the Indian Guarantee and General Insurance Company in 1961. Now, please remember, this was the era of private sector. The general insurance business in India was nationalized only in 1971-72. The LIC came into being in the 50s and 60s, and that too when the private sector companies were amalgamated. Same was the story with the general insurance companies also. So effectively, the era of government sector companies came into being only in the 50s, 60s, or 70s for general insurance companies. So this was the background in which we had the Reinsurance Corporation formed. Coupled with this was the fact that we had fire and hull pools in 1966. Now, it's interesting to note, why should we have a pool as such? I do not know how many of you are aware of this fact that when this 26/11 happened in Mumbai, and the Taj Hotel was put on fire by these terrorists who had come from across the border. What happened was that terrorism per se, terrorism as a peril, was not being covered in the Indian insurance policies. However, since the government and the GIC, they were aware that this terrorism as a peril existed. Therefore, with the support of the government and the other insurance companies, we had created a terrorism pool with an initial capital of, I think, 750 crores. Now, this pool was created because if a loss due to terrorism happened, and none of us could ever speculate as to what would be the quantum, kitne ka loss hoga, hame nahi malum. We did not know that. So 750 crores was a reasonable amount. Of course, as the events later on explained, it was a very, very small amount when it actually came to the quantum of loss for the fire insurance due to terrorism for the Taj group of hotels. In fact, if I remember correctly, somebody was telling me that the total losses due to fire had amounted to about 1190 crores, almost 1200 crores. And because the terrorism pool had a limit of 750 crores, they were paid only 750 crores. But that is not important. What is important is that a pool was created to cover terrorism risk. Similarly, we have created a pool for nuclear risks. So having a pool for fire and hull in 1966 was not something out of the ordinary. Even today, we are following with those pool structure. Why pools? Because primarily, none of the insurance companies would be able to bear the loss if it happened for one particular event as such. Now, I told you the quantum of loss for Taj Group of Hotels just because of fire was almost 1,200 crores. And then, of course, I'm not talking about the loss of lives. I'm not talking about the loss of business, the business interruption. I'm not talking about the foreigners who were there and n number of other, the personal accident policies, the health insurance policies, people were hospitalized. And there were n number of other losses. So actually speaking, if it were to be covered by 1 or 2 or 5 insurance companies, they would go bust. They would not survive. That was the cause of concern. So that meant the idea is that is why we have pools as such. So we had a similar pool in 1966 also, And of course, I told you that the general insurance business was nationalized in 1971, and in 72, GIC became the Indian reinsurer. Now, there is a small catch here, and let us be clear, because GIC as such was a holding company for the 4 government sector companies. It was also operating as a reinsurance company, but it was not only a reinsurance company. Let's remember that. The GIC in its present avatar of a reinsurance company came into being only in 2000, when the private sector came into being. But even in 1972, GIC, which was the holding company for the 4 government sector companies, was operating as the Indian reinsurer. Let us remember these 2 points, because we'll be referring it to later on. I showed you this particular to make it a distinction. I've tried to take a photograph of from one of the interesting reads which Swiss Re had sent to me, and this is how they say that this is the basic distinction between a primary insurer and a reinsurer. So they show the photographs of a car, a home, a family, a building, and clouds, and that these things can actually be insured by the primary insurer, and the primary insurer gets these things reinsured with a reinsurer. And that does not end the story. Why? Because the reinsurer can also go to another reinsurer or could invest that money in the government sector. So please understand, whatever insurance premium you are giving, apart from the risk coverage, the insurance company and the reinsurance companies are also putting it back into the economy. And you'll be surprised to note that during the pandemic time, during the COVID times, when almost each and every item on the agenda of the Indian economy was going down, insurance industry was one area which showed a growth in double digits. That's commendable, because whenever the nation or the industries, they have faced a situation where they needed support, the insurance company has lived up to the expectations. We had one major challenge, however, during this pandemic, and that was one of the points which came up for discussion. Of course, that was relating to reinsurance, that came up for discussion even in the United States. Can I ask a simple question to anybody who can answer? Anybody who can tell me who was the president of the United States during the pandemic period? Reshmi, would I take a chance? Can you tell me who was the president of the United States during the pandemic? You'll have to unmute yourself.
Yeah, I think she's telling Donald Trump.
Yes, Donald Trump. Actually, you are right. Now, the most interesting, and the reason why I asked you for the name is that during this pandemic, when the economy suffered reverses because of lack of insurance cover. How can you have a lack of insurance cover when almost all the industries have taken insurance policies? The lack of insurance cover happened because we did not cover the pandemic as such. So what happened? We had a factory. The machinery was up on a standstill. Why? Because no worker could go there. Why the worker could not go there? Because of the restrictions of movement. So the factory came to a halt. they started losing money. The loss of profit policy came into being, but the peril was not covered. So the business interruption policies did not trigger. Why? Because none of us here or in America, we had not taken the pandemic cover. But did the pandemic cover exist at that time? Yes, it did. And you'll be surprised that Wimbledon, this tennis event in London, they were taking a pandemic cover since 2003. That was the time when this breathing and respiratory problems called SARS had come into being, So in 2003, Wimbledon took a pandemic cover for $2 million US. The premium paid was $2 million US. And they kept on paying that premium for 17 long years, 2003 till 2020. So 17 long years, they kept on paying the pandemic premium of $2 million US. So $34 million US was paid as premium. And guess what? In 2020, they hit dirt load. The claim that was paid to Wimbledon in 2020 was almost 140 million pounds. I'm not talking about dollars. So was it not a proposition which was sensible? Every year they kept on paying $2 million US as insurance premium for pandemic insurance. And for 17 years, they kept on paying. And in 2020, when finally a claim happened, they got a compensation of, I think it was 144 million pounds as such. Now, so what I'm simply telling you is that this cover for pandemic was available in the international market. We did not have it. And Mr. Donald Trump gave an instruction to all the insurance companies in America that whichever company has suffered a loss because of business interruption, even if they do not have a business interruption policy for pandemics, please make the payment to them. Of course, this was overruled by the Supreme Court of America. They said if the insurance policy is not there, nobody can make that payment, But what I'm simply saying is that this particular cause of concern was global. It was not as if we in India were affected alone. It was affecting the entire globe. In spite of that, we gave a double-digit growth figure for the Indian economy. That is the importance of the Indian insurance organization, Indian insurance companies as such. So once again, I wanted to re-emphasize on the fact as to how the reinsurance works as such. And of course, this is almost similar to what I had already shown to you, just a reiteration of the fact. Are we clear so far? Any questions till now?
No questions.
Either I'm too good or nobody has followed anything till now. I take it the first aspect only that I'm too good and therefore no questions. Right. Now, let's go back to Now, this is important, because this brings us to the point as to the necessity of reinsurance. Why this reinsurance should be there? Why should the insurance companies get themselves insured again? And therefore, we say that an insurance company's actual loss experience during any one underwriting year may fluctuate. And why should it fluctuate? The pandemic happened in 2020. In 2019, the loss figures for health insurance, let's say they were about $50 million US. But in 2020, this figure doubled. So instead of $50 million US, which is a hypothetical figure that I have taken, the losses came to about $100 million US, double. So what happens is that in any one underwriting year, because of one loss or one pandemic loss or one catastrophic loss, we could have the fluctuation from the normal average. And this is what I'm trying to communicate when I say that an insurance company's actual loss experience during any one underwriting year may fluctuate considerably from its expected experience averaged over a period of time. So how do we handle this issue? How do we say that we will handle and manage this counterbalancing of the entire thing? How do we do that? There are 2, 3, 4 ways. One is we say, okay, this is compensation in time, meaning that this company is 20 years old. So the first 18 years from 2000 to 2018, we never had any catastrophic losses. So basically, we made money during that period. And we have accumulated reserves so that in the 19th year, when a pandemic loss hits us, we can handle it. The problem is that suppose that company started in 2018 itself, and 2019 we had the pandemic. What will those buggers do? What will those people do? Because the losses could occur in the beginning itself, before the company accumulated the reserves. Cause of concern, isn't it? Second is we say that we spread out the risks. So instead of insuring anything and everything in one particular locality, we'll say we'll cover it in 10 different localities. Why? Suppose I have 10 houses covered in a location, and if a fire happens in a location, all those 10 buildings would be burned. But if I have those 10 houses in 10 different locations and fire happens in only one of them, only one area would be disturbed. 9 of the houses would be safe. That is what we mean when we say compensation by spreading. We spread out the risks involved in it. The idea is that. Then, of course, we say, it's gone. Oh. Then we say compensation by diversification. When we say diversification, I mean, I will not only insure only motors in one area or only rivers, the marine traffic, in one area. I should go into other lines of business also. So I'll put some money on liability insurance. I'll put some money on fire insurance, motor. So I will spread by diversifying. The idea is that. Why? Because then at the end of the day, my risks are spread out. My different lines of business will take care of the fluctuations as such. But the most important one is compensation by leveling the peaks, by averaging it out. And therefore, the aim here is to bring amounts at risks down to a level so that statistical deviations are reduced to a minimum. Obviously, the risks are more homogeneous then. And therefore, I have put it in a different slide to focus on the importance of leveling the peaks. And how do we do that? This graph will tell you. The x-axis and the y-axis, the x-axis tells you the years, in which these things have happened, and the y-axis shows you the quantum and the amount. Now look at that. The first 4 figures, they are all above the average. But what about the 5th and 6th one? And then of course the 7th one again is gone up. But if we look at the term that I used was leveling this, So if I take an average, then almost all these figures would be leveling it out, in spite of the fact that the 6th year had a major shortfall. That is what we mean when we say we use the term leveling the peaks. Now, this is an important situation because some doubting Thomases can ask you this question, that why go in for reinsurance? I mean, I can handle these peaks by co-insurance also. Now, what is co-insurance? Now, it is basically a situation, a risk, wherein one insurance company shares the responsibility of the risk with more than 1 or 2 or 3 insurance companies. So, for instance, I have a government sector company, National Insurance. So, National Insurance issues a policy for covering, let's say, the Farakka barrage. Now, because the sum insured is so large, because the probability of a loss is so huge, that if alone, standalone National Insurance were to take the cover, it could create problems for them. So what they do, They will say, okay, fine. The sum insured is, let's say, 1,000 crores. They will rope in the other three Sarkari companies, New India, Oriental, United India. And they will say, okay, we share the risk at 25% each. So that any one insurance company does not bear the brunt of a catastrophic loss. The risks are being shared between 1 or 2 or 4 insurance companies. And therefore, we use the term co-insurance. As the name suggests, co-insurance means they also insure. So apart from the fact that you have one insurance company, there are 2, 3, 4 other, again, insurance companies. So therefore, co-insurance. However, the reinsurance means that the insurer who has covered the project of Farakka Barrage, they will pass on that risk to another company. Why? Because that reinsurance company has got the financial strength to handle this risk. So no insurance company is involved apart from the one that has underwritten the project. Therefore, co-insurance and reinsurance are two ways in which the peaks can be leveled. This is a graphical picturization of when I say that this is the risk and there are 4 insurance companies covering this, so this is basically, I'm trying to tell you that this is co-insurance. And this is a reinsurance wherein the risk has been covered by the insurer, but the black portion tells you that the insurance company's limits are being stretched. Therefore, they pass on that portion to the reinsurer. This is reinsurance. Now that brings me to an interesting point as such, that what exactly are the functions of reinsurance? Okay, till now, do we have any questions, any queries?
Yeah, there is one question from Mr. Fazal. Sir, you can tell us about company insurance clause.
Company insurance clause. And this is in context of?
Yeah, Fazal, you can unmute yourself if it's co-insurance.
Oh, co-insurance.
It's a co-insurance clause.
Okay, fine. That's exactly what I was explaining, this co-insurance concept, So co-insurance is basically between insurance companies, whereas reinsurance involves one insurance company or 2 insurance companies and another insurance company, which is normally not into the transactions of insurance. They will only cover the insurance companies, not the clients. Co-insurance is by insurance companies who have a direct dealing with clients. Reinsurance is by those companies who do not deal with clients as individuals. Their clients are insurance companies. And that is what I was trying to explain in those diagrams that I showed you here. This particular thing, how reinsurance works, insured and an insurer which is a reinsured and a reinsurer. So for an insurance company, the client is an individual. For a reinsurance company, the clients are the insurance companies. That's the basic difference.
I think there's one more question. Hull pool, does it exist now, from Ms. Nalini?
No, it does not. And even if it were to exist, please believe me, because how many of us actually remember that any of our commercial liners or cargo carriers have actually gone down the drain? They have met with losses. There are so many complications right now that the hull is a neglected part of the Indian insurance sector. Now there are n number. In fact, I was lucky at one time, sometime in 2016, when I was involved in insurance of 3 ships, hull insurance, of course. They were based out of, 2 of them were based out of Mumbai and 1 was based out of Goa. But the fact remains that because of advancement of technology and the quantum jump in the reinsurance capacities, now individual insurance companies with the help of reinsurance support can give you the hull coverage, hull pool as such. So honestly speaking, I haven't heard of the hull pool after 1991 or 92. almost 30 years now that I've not heard of the hull pool. So I safely assume that it doesn't exist, and even if it exists, it's of no use right now, because whatever the capacity of the hull pool was there. I mean, presently, even a small insurance company could be handling maybe 5 times that worth today as a marine hull, because of the technology advancement and support from the reinsurance companies. Ms. Venugopal, you wanted to add something?
Sir, this was in because you said you are from United India, ex-United India, is it?
Yeah, it is.
I work for New India Assurance.
Oh, wow.
So GIC is our treaty reinsurer.
It is.
Till about last year, we did have a component called pool. Pool in our reinsurance program. But what was the purpose served with this pool is still unknown. It was just that the 4 companies will put in all kinds of business, not the good ones, and then you end up paying a huge price. So the thing you told us that the hull pool started in 1966 was baffling to me, because it would have been started with an idea of reinsurance, but by the time it has come to GIC in this form, it was terrible. So ultimately they have called it off. So I just wanted to know what was the purpose served with this pool. I hardly could find anything.
I'll tell you.
Mess. The accounting was in a big mess.
I'll tell you the inside story, if I may call it, because I was lucky that one of my batchmates was with GIC since 1994-95. Presently, that gentleman was handling he was the CEO of the Dubai branch of GIC Re, which was scrapped about 2 months back. But he's still in Dubai right now.
What's his name, sir?
Balaji Tyagarajan. So we are from the same batch, 89 batch. So I was lucky to have him there in the GIC, because and my interactions with him went beyond the professional level, on a personal level also, because his family was known to me and things like this. But I'll tell you what happens is that, for instance, in 2009-10, when I was working, one of the founding members of L&T Insurance, I was working on this motor pool. Now, motor pool had 2 components. The first phase, which came out in 2009-10, and the second one in 2011. And why the second one? Because the London actuaries had come and they had estimated our third-party losses to be increased from about 120% to about 136%. And that is how the motor pool changed its character and it came out in the second form. But when we were working on that motor pool, the idea was to ensure that each and every insurance company did its own share of third-party business, however bad it was. And because it was bad, therefore it would be put into that pool where everyone had some sort of a share. I personally believe that this concept of hull pool in 1966 was not the same. It was there because none of the individual insurance companies on its own could cater to the requirement of one hull loss. The sum insureds were so huge, and I'm not talking about the liability claims coming after that, because the liability claims would have also come, So I think that was the reason why it was formed. However, with the improvement of the RI treaties, the reinsurance arrangement, and of course, development of technology, you could track and ensure that the vehicles were, the ships were at this particular location, send in fast reinforcements, safety measures, I think gradually and slowly the pool, that hull pool lost its importance and value. And probably that is why it was faded out, kind of thing, without creating a situation. But just to update you, probably January, when we have this rendezvous in Mumbai, of course, and I'm an invited participant there, we'll be again meeting Devesh Srivastava, GIC Re chairman, is an old friend of ours. So now that you mentioned this, I'll ask this question to him, and rest assured, you will get a pakka response through Rakesh ji on this.
In all probability, I would be attending the rendezvous, sir.
Oh, great. Then let's catch up there only and ensure that Devesh Srivastava responds to our queries, that this is how it has happened. Chaliye, wonderful. So, right now, Rakesh, can we proceed now?
Yes, yes.
Right. Okay. So, this is the time when actually, we should stop, think as to what exactly are the functions of reinsurance. I mean, reinsurance is there. Pehle to ek hawa create kar diya jata that that reinsurance is something out of this world. Come on, reinsurance is like any other insurance thing. It's just that most of the people do not get an opportunity to work in reinsurance department. Therefore, this concept that it is alien to us, it is not. With the coming of the private sector, many people were introduced to the functioning and working of reinsurance. And that is why reinsurance is not alien today. We use it to our advantage. So what exactly are the benefits, or should I say functions of reinsurance? The first one says that increase the capacity. Now, how does, I mean, if I have a scooter or a motorcycle of, say, let's say 100 cubic capacity, can I increase the capacity of that two-wheeler from 100 to 200? Or if I have a car, with a 998cc engine, can I increase it to 1499cc? Obviously, no, it's not possible. Here, when I say increased capacity, I'm talking about increasing the financial capacity of the insurance company. So, for instance, the private sector companies that came into being, let's say in 2000, Tata AIG started off. Now, when Tata AIG started off with a capital of, let's say, 400 crores, do you think it was possible for Tata AIG to insure, let's say, Bombay High platform for about 2,100 crores? No, it was definitely not possible. But with the help of the reinsurance AIG, they could have easily done it. And I do not know whether AIG has ever been a part of coverage under the reinsurance arrangement for Bombay High. But if at all Bombay High were to be insured by any of the insurance companies, there would be adequate RI support. That is what is the meaning of the term called increased capacity. So my underwriting capacity with 400 crores capital could not have been more than 400. Why and how? Because the solvency margin is important. As an insurance company, my liabilities cannot be more than 1.5 times of what I can actually pay. 1.5 is the solvency margin. Therefore, when I increase my capacity with the help of a reinsurance company, I am assured that my solvency margin would be safe. And that is where we say protection of solvency margins at point number F. Now, financial stability, way back in 2006-7, 2008, sorry, when 2611 happened, I was heading underwriting at IFCO Tokyo. And one of the individual personal accident policies, IPA, was to be issued to the founder of Yes Bank, this gentleman, Rana Kapoor's elder brother. I'm forgetting his name, and that gentleman was a very well protected guy. He used to move around in a bulletproof car with 6 bodyguards. So my Mumbai office kept on badgering me that we need to give this 10 crore cover to this gentleman. Now, as the underwriting in charge for IFCO Tokyo, I knew my reinsurance limit for individual personal accident was 4.5 crores, meaning thereby that if a loss of 4.5 crores came in, the reinsurance company would support me. But if the loss was more than 4.5 crores, that had to be borne by the insurance company on its net. And in this case, if it was 10 crores, then the balance 5.5 crores would hit the net of the insurance company. And that was the time when IFCO Tokyo used to have a profit of about 24 or 25 crores in a year. Now we said no, because if one loss of 10 crores came to us, fine, 4.5 crores would come back to me from the reinsurance. But that 5.5 crores would bring down my 25 crore loss to straightforward 20 crores. Therefore, the financial stability of the company would be affected. And you'll be surprised to note that on a gut feelings, purely simple instincts, I refused that individual cover And that gentleman was killed the very first night in Cafe Leopold. I mean, we escaped that particular financial instability as such. But these are the chances that people take, you know. He was a well-protected guy, bulletproof car, 6 bodyguards, nothing can happen to him. And look, there you are, he was killed. And it was an accident, actually. So 10 crores would have to be been paid for that. Thankfully, we were not the insurer at that time. And therefore, we averted the instability, the financial instability that could have hit us had we given that cover. Now, the third point is stabilization of claims ratio. How do we stabilize the claims ratio? Now, please remember this particular leveling, you know. Let's say these are the different claim figures for 7 different years. They are not the same for any one year as such. But with the reinsurance support and leveling each and every particular year with the RI support, the insurance company would have fared well. Why? Because by their arrangement, whether it is a treaty or whether it is a facultative or any arrangement that the reinsurance company has, they would ensure that the insurance company would be compensated. And that is how the claims ratio do not go beyond a certain limit. So let's say in motor insurance, once again, I'll give you a very simple example. So motor insurance, Tata AIG way back in 2005, they used to say that any vehicle which is more than 50 lakhs will need to be approved by their corporate office. Meaning that 50 lakh rupees was the limit of their treaty arrangement. So if someone had a car which was valued at more than 50 lakhs, before insuring that, they would cross-check with the reinsurance company that, okay, I have a situation of a car which has to be insured for more than 50 lakhs, and therefore, is my reinsurance arrangement in order? The moment they say that reinsurance arrangement is there, the policy would be issued. Now, suppose that car met with a total loss. The loss was, let's say, 70 lakh rupees. Because of that reinsurance arrangement, depending upon the net retention, you know, the 70 lakhs claim would be protected. The reinsurance company would give it back, and therefore the claims ratio would be stable. I mean, you cannot have one particular claim going up, you know, 200% kind of thing, you know. Why? Because that money is already coming back to us. The fourth one is accumulation of claims under different class. Now, because of the reinsurance support, my capacity increases, you know, my financial stability is there. So what do? I diversify my business into other lines of business also. So instead of being like QBE Raheja company, which started off by focusing only on liability insurance, after 5-7 years, they started to diversify their business into motor and fire and rural also. The ACO insurance company, they started off by saying that we are a digital company, you know. Now, after 4 years, now they are recruiting people to handle other lines of commercial lines of business also. So what happens is that once the stability is there, you know, once they know that this reinsurance support is there, my capacity for underwriting is increases. Therefore, I will diversify into other areas. This is like normal business proposition. I open up a shop in, let's say, Chandni Chowk of Delhi. Let's say it's a sweet shop, you know, and that particular sweet becomes a brand name for us. For instance, what is the name of that Rasagulla Chaurangi ka? I'm forgetting the name. Samdas. Rakesh ji batayenge wo
KC Das.
KC Das, yeah, KC Das. Now, KC Das is a brand in itself. Now, KC Das, people know that, okay, the market in Kolkata is saturated now. So what do? They open another shop or a business in Delhi. And KC Das, because it's a brand, people are ready to buy it here also. So what they do is they go into different class of towns, you know, for business. They are diversifying. The moment you start diversifying, probability of losses decrease. Why? Because one area you would have lost something, in the second area you would have gained something. That is how. So when it comes to accumulation of claims under different classes, you are safe. Why? Because you already diversified. So liability insurance is already taken care of by RI arrangement, and probably because of one claim of Satyam, 2008-9, the policy was by Tata AIG, and initially Tata AIG refused that. They saying that no, we do not cover this particular loss. But now we have only paid the legal expenses for that claim till now. The class suits and actual compensation has not been paid till now. We are expecting that this particular claim would cost Tata AIG anything to the tune of about 7,000 to 10,000 crores. Now, a claim like Satyam happens probably once in a lifetime, but that particular claim is sufficient enough to wipe out the entire premium for liability insurance, which Tata AIG would have earned in 20 years. Had it not been for reinsurance support, Tata AIG would be in trouble. But obviously they have the reinsurance support, therefore they're not worried about it. But what I'm simply telling you is that the quantum of loss are so huge that on your own it's difficult to stand, and therefore you must have the reinsurance support. Same is true for spread of risks. Now, for instance, Uttarakhand is an area, even Gujarat for that matter, where you can have flash floods. If that is so, areas of Bihar, they are more prone to earthquake, bordering the Nepal Tarai, Bangladesh, floods, for that matter, West Bengal, Bihar, all these areas are prone to floods. But if I were to insure only in Bihar, and that too only flood risks, if I were to insure only in Bihar for earthquakes, obviously when the claims hit me, I'll be lost. I will not be able to survive. So what do? I spread my risks to Uttar Pradesh, Madhya Pradesh, Odisha, Delhi. I spread all around. So if I lose 2 rupees there in Bihar, I gain 2 rupees there in Delhi. I spread my risks all across so that it helps me in surviving there. I told you about the solvency margins as such, because the regulator, and we are lucky that, on this point of regulator, let me ask you another question. In 2008-9, when the entire world was reeling under the economic impact of Lehman Brothers, we in India suffered, of course, but our quantum of sufferance was less as compared to the others. And the reason that we finally arrived at was that because our regulators were very paka. Our regulators ensured that whether it was the banking industry, whether it was the trade industry, trading corporation as such, or whether it was the insurance company, the regulators maintained the high level of policy issuances and guidelines to ensure that none of the activities went beyond board. At times we used to wonder, saying, license Raj hai hamare yahan. But thank God for that license Raj in 2008-9. Because of that, we survived. The banking industry survived. Of course, there were other reasons also, but this was one of the important factors, that the regulations regarding the solvency margins were there in black and white, and people had to follow it. There was no question of escaping that. And of course, this entire process would lead to profitability being stabilized. At the end of the day, if I know that I'm going to pay a claim of 100 rupees and the total money that I have is 200 rupees, I'll say, okay, my God, 50% loss ratio. But if out of that 100 rupees, I get 80 rupees back from the reinsurance company, imagine my situation when I say, oh, my loss ratio has actually gone down. My profitability increases. And thanks to reinsurance as such. So if I were to sum up and say what exactly are the functions of reinsurance, I will say that, and I use the keywords. Keywords are absolutely simple in the sense that these are the terminologies which you just have to use and the people will understand what you are trying to tell. You don't have to give an explanation after that. When I say providing increased capacity, providing financial stability, and enables insurers to accept new risk exposures. Now, these are the key words wherein we explain the functions and role of reinsurance. It is important you to understand that if you are to use these keywords, you do not need to give an explanation after that. These keywords are self-explanatory. What is a bordereau? Now, this is a French word and it is pronounced as bordereau. I mean, honestly speaking, if you were to speak to some of the employees of reinsurance companies of present times, when I say present times, I mean post privatization, most of them would not know this terminology called bordereau. Why? Because now the system-driven programs are there where it prints and issues a list of all the risks under the treaty which has been ceded. This, prior to 2000, was a document that was prepared by hand. I have done it when I was in the government sector company. And it used to be a big register, and we used to prepare this list in a manual form, wherein we used to list out the risks which we had ceded to the reinsurer under the treaty. And this list had to be submitted. This list was to be verified by the reinsurer. And suppose I had sent in a list of 10 risks. The reinsurer sends back saying, sorry, we cover only 9. Then that means I was in trouble. Why? Because I had missed out one risk to be sent to the reinsurer. And since it was a manual process, this had 2-3 different levels of verification. So as a piddly AO in 89-90, I used to prepare that. Then my ADM, who used to be an AO, administrative officer, he used to check it. Then it used to go to my divisional manager, who used to verify and sign it. Then he used to send it to the regional office, where some higher official in the regional office would sign it and then send it to the corporate office, to the head office, and it to be signed by the reinsurance team there. And then it used to go to the reinsurance company. So 4, 5, 6 different layers of verification, because reinsurance used to affect the book of accounts. The reinsurance treaties could actually lead to losses being mounted on our head. That is why the importance given to a bordereau. Bordereau was nothing but a list of all the risks ceded to the treaty, and we used to submit it to the reinsurer. Of course, when we mention the risks, we give the details of the name of the insured, the risk occupancy, sum insured, premium rate, and most important thing is the insurer's retention. What is the insurer's retention? Retention purely means I retain, I keep it to myself. So let's say I have a car to be insured, and I speak to the insurance company. I'm a client, I'm not an insurance company. I'm a simple insured. I go to, let's say, national insurance company and say, I have a car to be insured. And you, even though the value of the car is 5 lakh rupees, you cover it for 4 lakhs only. Why? I am willing to retain that 1 lakh rupee. Do you think the insurance company will agree? It will not agree, for the simple reason that this becomes a case of underinsurance. This is not retention. Retention primarily comes only when the insurance company says that out of this total premium, I am willing to retain this part of premium, balance I will send it to the reinsurance company. So retention is not for individuals. Retention is only for insurance companies, or again, in case of a retrocession, the reinsurance companies as such. So retention is prerogative of the insurance company, and the retention could differ from line of business. So for instance, I know that fire is a profit-making area, so I will retain more premium there. Why? Because if a small loss happens, I will pay, and losses are very few in fire insurance as such. But I know motor is a loss-making proposition, so I will retain less. I will cede out more. I will give more to reinsurance companies. Why? Because more losses happen and I should get back my claim from the reinsurance company. Now, this bordereau, we used to submit on a quarterly basis. However, today, because it is system driven, it is now normally submitted on a monthly basis. And similarly, identical list used to be there for claims. So one was for risks that were to be covered, and the second was for the claims that were to be paid. And therefore, the two were separate. Now, interestingly, what happens is that the word bordereau, which is of French origin, came into being only because of the fact that the French reinsurers, and I think AXA is one of them, when they started off their reinsurance activities, they used to insist on a statement by the insurance companies. That statement, as the details are mentioned there, all these details were not there at that time. What the details were made available to them was primarily for the premium and claims paid. Of course, later on, at a later date, more details were incorporated, and that is how the bordereau in this present form is made available today. Like I told you, nowadays insurers have dispensed with the submission of bordereau, except if it is a new company. Why should a bordereau be issued for a new company? No? I mean, if it is not there, it is not there at all. But if it is a new company, the reinsurers ask for it, may ask for it. Why? Any ideas? Okay, I'll tell you. You see, what happens is that most of the insurance companies have been in business for almost, at least 10 years for sure. I think the last insurance company that came into being was in 2012 or 13. So almost 10 years, almost each and every company has been there. And during the 10 years, you get a trend that what kind of business these people do, what kind of claims do those people handle, and overall, what is the performance of the insurance company. If you drill down to certain more basic information, you'll find out the lines of business. Okay, so fire insurance, they are doing so much of business. Marine insurance, they are doing this. Liability, they are doing this. And this is the loss ratio that these people have. So basically, in a nutshell, you have the information and the data to slice and dice, and you get the informations which are relevant to you. However, when it comes to a new company, without informations in the form of a bordereau, how can one actually give you a trend? What kind of reinsurance policies that these people can ask for? Because lines of business will determine the kinds of reinsurance arrangement. If somebody is more into liability, he will heavily go into reinsurance because liability claims are huge. Satyam is the example I gave you. Suppose someone is actually only into, let's say, motor insurance, like Shriram General Insurance. When they started off, they were doing almost 85 to 90% motor insurance. And they had their own retention limits and they were in profit. They did not need much of the RI support at that time. Now, of course, over a period of years, now they have also realized because of diversification that they need more reinsurance support. So initially, when the reinsurance company is there, to know these details, they would ask for a bordereau. And that is why the emphasis that we may have dispensed with it, but when it comes to a new insurance company, the reinsurers may ask for it.
Can I ask you a question, sir?
Sure.
I mean, it may not be directly related to what you've said, but when it comes to taking a reinsurance, especially with a treaty reinsurer, which you may ask Mr. Devesh when you meet him, they maintain a very high deductible. Now, see, I handle Hull, and lately even cargo is with me. In Hull particularly, at least the particular average claims, the small ones which come up, it may go maximum up to say 8 or 9 crores. Let us say, unless it's an AOG or something which happened in Kattupalli.
Correct.
Something like that will be huge, and for that you need reinsurance. But if you keep your treaty deductible very high, I am not getting any recovery from the treaty reinsurers. So where is it that the book is getting balanced? It is not. Going by the law of large numbers, and if you really take the statistics for the last, I'm talking about my company, of course, the last 10 years, why shouldn't we explore possibilities? I don't know what is the regulation which makes us go again and again. I hope there is no GIC representative here.
don't worry. This would not be quoted anywhere. Rest assured about it.
But it's been recorded. But I don't mind, because I had asked the chairman himself. I had asked Alice Madam also earlier, and I did go and consult another RI expert. So he said, you're absolutely right. If you're not getting any recovery from the reinsurer, then you should explore other possibilities. See, you are looking for a balance in your books of accounts also. It's not just AOG. Now, AOG has become the order of the day now, because every year there is some AOG. So now it is effective. I don't agree.
Absolutely.
You may get a higher price for that. That is okay. But what about these small losses? See, reinsurance is again an insurance arrangement where all of us pool together and take a compensation, small compensation.
Correct. Absolutely correct.
What is your suggestion on that, sir?
Ma'am, it's not a question of suggestion. I'll tell you the reason why it happens. You see, each and every insurance company has got a different philosophy. Now, the reason why I say different philosophy is because I have seen one of the documents at the IRDAI wherein they identified and gave their reinsurance arrangement philosophy. And mind you, okay, I will not specifically mention that particular line, but when I read it, they quoted their own previous owners. Okay, fine, it was New India, and they quoted Tata's, saying that from their times, this was the proposition, this was the policy that they were doing, and we have been taking it. Now, okay, fine. What Tata's did prior to privatization was a different ballgame altogether. If let's say United India Insurance were to quote the Fire and General United, that private company, now the thought process behind the companies changed when the owners changed. In case of New India, there was hardly any change. And I can tell you that the reason why the deductibles are high, because when you have a discussion with them, they cite you losses and they'll give you the entire, they'll throw the book at your face, that these were the losses there in the previous years. Point noted. But tell me something. If I, as an individual, I go for a motor insurance policy and the insurance company tells me the deductible of 1,000 rupees is being increased to 10,000 rupees. And my average claim size for, let's say, motor is 8,000 rupees. Now, how many claims would be admissible at that time? So who gains there? I end up paying my premium. The insurance company is already paying that reinsurance arrangement. They also have, if similar structure exists, then the insurance company is wasting its time. And who's making money? The reinsurer. Now, in India, the challenge with us is that GIC Re has got the first right of refusal. You and I cannot question it. And by and large, arm twisting tactics happens. And that is why I said that nobody will quote you in this particular instances, because of the fact that, yes, it's a fact that the arm twisting tactics happen. And to show a good book of accounts, whether it is for GIC Re or for any other insurance company, and these are the methods, Now, tell me something. If actually you can see this sitting in Kolkata, don't you think that people sitting in the accounts team or in the reinsurance team in your corporate office, did they not see it? And if they have seen it, what have they done about it? So, it's all a vicious cycle, when it comes back, because most of us are aware of it. You have raised a voice, they have not. And And who benefits in the entire process? The reinsurer. You are paying the reinsurance premium, isn't it? No, but there's no stopping there. Your average claim size is improving or going down. Nobody's bothered about it. Fact remains, okay, yes, my reinsurance arrangement is there. So actually speaking, it's more to do with an individual, because what happens is that people sitting in high places, number one, they will take a plea, "Hame to kisi ne bataya nahi, nobody told us this," that kind of thing. Damn it, why should someone tell you? You have the book of accounts in front of you. Each and every regional office, they submit their book of accounts. Why can't you have a look at it? Why can't you look at the reinsurance arrangement? And particularly for a segment like marine hull. My God, I remember way back in 1996, 95, 96, the reinsurance team at United India, there were 11 people there. And I always thought that 11 people were slightly a bigger group as compared to the other insurance companies. So, the fact remains that most of us prefer to be ignorant. Given half a chance, I will turn a blind eye, theek hai, ho raha hai, hone do yaar, mero kya karna hai, that kind of thing, the reinsurance is not my baby. But fact remains that when the book of accounts come into the picture, when you don't get your PLI, then somebody somewhere cribs. And then the issue comes back,
my God. There is no
Sorry?
PLI, sir, thankfully. There's no PLI now, so that's okay. Another, the corollary to the whole thing is when there is a big claim, you do get your compensation from the national reinsurer, but you're also charged a booty because your layer is burning.
Yeah, I know.
We have an excess of loss treaty. So then the first layer burns, the second layer burns, the third layer, then you're paying, almost equal to 3 times or 4 times of the premium. So where is the balancing act? I really don't know.
I can understand the point you're coming from. Remember that case of Tamil Nadu, this Prime Minister's health insurance policy when Madam Jayalalitha was there, and Swiss Re had given them an excess of loss of cover,
yes,
which finally went into an investigation. Because, 130%, how can you have a health insurance policy where the excess of loss cover goes beyond 130%? Something was wrong somewhere, and that is the kind of thing. Because at the end of the day, someone somewhere actually went through the documents and some whistleblower put into these details into the vigilance team, and it was a very bad show at that time. So this happens, it's not that it has happened with you alone. It has happened with other insurance companies also. It happens in the private sector companies also. The advantage that the private sector companies have is that they don't wait for an investigation to happen or a vigilance inquiry or maybe, all that audit and accounts section coming into the picture. They will simply fire that guy and they of course go into the damage control situation. But it happens almost in every organization. You chose to spoke out. I gave you the example of United India, but there could be 100 other such cases which do not come into the limelight. So, that is one of the challenges that we face. But I guess at the end of the day, there are more people working for the betterment of the organization, and that is what has kept us going all this while. I personally believe that at the end of the day, there are more good people working than people trying to damage, So I can only say that you can take down my email ID and phone number, and we'll stay in touch. This is
your mail ID.
Because this is one particular topic which is close to my heart in the sense that yes, I can empathize with you. I know how it is, which many others may not be in a position to appreciate it. But yes, been there, done that, we know it. It has happened and it will happen again. But it's just that, is the industry ready for it? Question is that. Because if it's happening with one organization today, suppose it were to happen simultaneously to all the organizations. What will happen to my book of accounts at GIC Re then? Can they show us the profit that they've been showing? No, not possible. IPO to doom gaya waise bhi.
Two possibilities. Why should they just stick to one? You can give us 2. You can say you want this. This is the price. If you want the other choice, you take that as the
price. This is a very, very debatable topic that you are going into now.
I'm sorry, I deviated from
not at all. Not at all. Not at all. I'm so glad someone is raising this issue, because what happens is that this issue of the first right of refusal, and I remember it pretty well because this was discussed in details. I'll just share it with you. My wife is from LIC, but she's presently in the Department of Financial Services looking after insurance, and for the last 6-7 years. So, I always have the first-hand information of what is happening with the ministry and the IRDA. And I remember both of us sitting down on the dining table and discussing that entire document threadbare, as that it didn't make any sense. Thank God for it that they made minor changes. Of course, n number of changes were suggested, but even at the level of the government, bureaucratic pressure and the pressure from these people who are stakeholders in the insurance companies. I would not like to name them, but a lot of pressure is there. There are reasons why the new chairman is not being nominated for the IRD, and specifically waiting for an event to happen. Once that event happens, automatically the guy will be there. We are all aware of it. We know how the system is functioning, but in spite of that, that is what I was saying. In spite of that, there are still good people working, and probably that is why we are still where we are right now, and we have not gone down. So I simply I can only tell you that you should keep up your spirits up. I know working in a government sector, particularly in a situation what you're talking about, can be depressing. Believe me, that what is happening is not correct, and you're not in a position to do anything about it. But believe me, by and large, there are people who are working for the benefit and the good of it. So chill out. Don't worry about those things. Hota hai, hone do.
One last question, sir. Is there any risk modeling available? If I can get in touch with you over the email, because just to understand how they price you, and just to, you have to, when you argue with your reinsurer, you must have a firm footing. So there should be a risk modeling available to the poor insurers also. Who can
I'll tell you what you say is absolutely correct. In fact, during the last 3-4 months, we were lucky to have interactions with Milliman, and Milliman is based out of Gurugram, and RMS people had come to our institute for a lot of brainstorming sessions. The major challenge that at least these two risk modeling companies told us was the fact that the last 25-30 years, because of the climate change and global crisis, the NatCats, the phenomena of NatCat has undergone a change. So much so that now the models that they are creating, they are worried as to whether it will stand the test of time or not. They cited specific examples that the last 60 years NatCat events in Southeast Asia, and the last 30 years, only the last 30 years, it was almost equivalent. The quantum of losses were almost equivalent. So you can imagine the challenges that these risk modeling companies have. They also have to face this problem. But now that you mention it, let me just speak to these people at Milliman and RMS, and if they can be of any help, rest assured, I'll put them across. Don't worry about that.
Thank you, sir. Thank you.
Rakeshji, can we take a break here for 10 minutes, and then again we'll start off?
Yeah, we can.
Right. Thanks, sir.
I'm sorry if I have delayed your schedule, but
No, not at all, ma'am. At least I'm so happy that the interaction process is on, because that is what I was aiming at. Giving a monologue is of not much interest as such.
Yeah.
So we will again back in 10 minutes.
Sure, sir. Absolutely.
I think we can resume now.
Yes, absolutely. So, ladies and gentlemen, let's get back to what we were doing and what we were doing good. Before we start off, I would just like to have a recap, what exactly did we do in the last 90 odd minutes, And when we talked about what exactly is the term called reinsurance, we also talked about how exactly reinsurance helps us. We talked about the distinction between co-insurance and reinsurance. And of course, at the end of the day, what matters most is that reinsurance as an economic tool for the insurance companies, and at a later on, the entire economy as such. So before we move further, and of course, the border, I forgot about it. The reason is very simple, because this particular document is becoming outdated now. By and large, with the systems and processes and the technology because of which these systems and processes are made available, they have become so advanced that you talk about any reinsurance company worth its salt, and they will give you the entire history of a particular insurance company for the last 20 odd years. I mean, as early as the time when the first entry into the system was made. So from that perspective, yes, we are moving forward. But as rightly mentioned, ma'am, you are right, because there are many occasions when you feel that people are being left behind and that there's still much to do. We always feel that there are people who are still working for the good of the organization, and that is because of these good people that we are still able to manage, and we are in a position here to talk about it as such. So let's proceed on. And where's this? This doesn't. Yeah. So what exactly is the reinsurance contract? Let's come down to the brass tacks. So the reinsurance contract as such basically are of two categories. One is the facultative kind of arrangement, and the second is the obligatory, the treaty, as we say. Obligatory is a word that we don't use it anymore, in the sense that the word treaty is more prevalent now. Now, the idea is to give you a brief overview as to what kind of reinsurance arrangements are made available for an insurance company, because various factors are there, various reasons as to why somebody would go in for a treaty arrangement, or why could someone go in for a facultative arrangement. Suffice to say that because of the underwriting methods and the claims methodology, these are the two factors which determine the economic position of the insurance company. Why? Because if my underwriting practices are solid, they are good, I will ensure that I will rather weed out those cases or those policies that are sure to give me losses. And if the claims management is good, I will sell claims management as my marketing tool, because we are so good at settling claim, we are so fast at settling claim, and we are so efficient that people would come to us to take a policy. So whether it is the treaty arrangement, the facultative, or the proportional, the non-proportional, any of the words mentioned on this slide, they are all Greek to us if we do not understand that the underwriting and claims management system are the basis on which all these separate categories of reinsurance arrangements are done. Could be a repetition for some of us here. However, in the wider interest, the numbers being mentioned here, I think we will start off with the basics. Two types of reinsurance, I said, facultative and obligatory or treaty. And of course, each type of reinsurance can be structured in either a proportional, which is the pro rata way of doing things, or the non-proportional, which is the excess of loss category kind of thing. I think I need to rework on my reinsurance cases now that I'm losing touch. because I haven't been putting into practice. But okay, so back to the basics. There are two types of reinsurance arrangements: the facultative and the treaty. And of course, either the facultative or the treaty can be structured in the proportional, which is the pro rata way of doing things, or the non-proportional, which could be the excess of loss. Now, I personally feel that facultative reinsurance is the more difficult one rather than the treaty or the obligatory one, for the simple reason that this particular reinsurance applies to individual risks. Way back in 2006 and 7, vehicles which were running on the tarmac of the airport, these buses that transport passengers from the terminal to the aircraft, these what do you call those loaders that they push the aircraft on the tarmac, or the tractors carrying the goods and the passengers luggage, they just go to the aircraft. These were all excluded under the treaty arrangement that we had for IFCO Tokyo, 2006, 7, 8 I'm talking about. And then I got an opportunity of interacting with somebody who was pretty senior official in the Jet Airways, and they requested that IFCO Tokyo give them an insurance cover. Now, I tried to reason it out with them, saying that, the treaty does not cover this. And the fellow was absolutely aware of it, because the moment I said our treaty does not cover it, he says, "Sir, why don't you try the facultative method?" Now, coming from someone who is a non-insurance guy, if he talks about facultative arrangement, the warning bells should go off that the people are aware of the reinsurance arrangements. Now, the reason why I mentioned this incident of Jet Airways is because, by and large, facultative reinsurance takes care of individual risks, something which is not covered under the normal treaties. Because the treaties that we have, we agree on certain percentages, certain amounts, certain categories, lines of business, and we say, okay, fine, as a general arrangement, this will be covered. Therefore, it is generally used to reinsure extra hazardous or unusual risks which might be excluded from treaty arrangements. The case that I gave you about the Yes Bank owner, the sum insured was 10 crores, not covered under my treaty. I could have gone in for a facultative arrangement, which was unusual risk, 10 crores was pretty high at that time, of course. And or we talk about high valued risks with policy limits exceeding maximum treaty parameters. Similar situation. So for instance, if I say that, okay, my treaty covers 20% of the total premium, and I have one particular risk wherein the premium is almost more than what my total average 20% is, that will not be covered under the treaty arrangement. Then what do I do? That is precisely why you have the facultative arrangement. And this is one of the difficult ones. Why? Because the role of the underwriter is crucial here. The poor fellow, he has to put everything on stake here, because if something goes wrong, then this is one of those rare exceptional cases, because the treaty did not cover it. So he went out of his way to cover it. And then, of course, there are probabilities and possibilities of those happening, because insurance is all about staying in the business of risk. Just 2-3 days back, I read this news article saying that the insurance cover for satellites has started going up. Why? Because of the different nature of losses that are coming under this insurance policies now. So the loss does not pertain only to damage or the satellite being launched. There are other claims also coming in. Honestly speaking, I was not aware of the other kinds of claims as such, because all this while the focus had been, for instance, way back in 70s when this Skylab was there, the American satellite, and it had malfunctioned or it had lived its utility and it had to be brought down. So that was the time, for the first time, we heard that the satellites were insured. So from that time, almost in 70s till about second decade in the century, it's almost 50 years, And in these 50 years, we have seen the ups and downs of the insurance sector. And then today we get to know that the premium rates for satellite insurance is going down. Now, believe me, satellite insurances are not covered under the normal treaties because they are so high valued objects that you have to have a facultative arrangement for that. Now, imagine a situation wherein, let's say ISRO comes to us saying that they want to cover this satellite that is to be launched. And for some reason, in its very launch, it burns out. I would go out of business, because such a huge loss is there, and that too under a facultative arrangement. Individual risks, high valued risks with policy limits exceeding the maximum treaty parameters. These are extra hazardous or unusual risks. Therefore, I personally feel that facultative reinsurance is a difficult one as compared to the other line, which is the obligatory one or the treaty one, where anything and everything in that policy, in that particular line of business is covered up to a certain percentage. There you do not have to exercise discretion. You don't have to exercise and use your brains to ensure that the right category of risks are covered. So the second category, which I said, treaty or the obligatory one, this applies to an insurance company's entire book of business, entire book of insurance premium. And of course, some of these could include all commercial fire policies, all automobile policies, workman compensation, homeowners, any combination, So you work out, and not only the lines of business, you'll be surprised to note that there are certain reinsurers, who will mix up 2, 3, or 4 different categories of treaty insurance policies and have come up with something like one of their own, maybe a quota share and something mixture kind of a thing. I was surprised at one of the treaties that I saw, that RI slips that I saw, and it had mentioned something like this. So please understand the basic difference between a facultative insurance, which is one of its kind, normally used to reinsure extra hazardous goods and high valued risks wherein the policy limits are exceeded, and a treaty insurance which covers the entire book of business. So these two are separate. The facultative arrangement, difficult one, individual risks, and it takes care of high valued business where the discretion and the rational, the logic, the thought process behind the underwriting comes into the picture for the underwriter. And the second one is the treaty insurance, where in the entire book of business, entire book of insurance policy for the insurance companies taken into account, and a certain percentage fixed or a certain amount of business, they automatically, and it's an automatic process. The most important thing is that. So that is the distinction between the two. Now, the proportional reinsurance, which could be a part of either the facultative or the treaty, like I said, proportional means pro rata kind of a thing, So one or more reinsurers take a stated percentage share. So what do they say? Okay, fine. I have a motor portfolio. So for each and every motor insurance policy, I will take 30% of the premium, which is a stated percentage share. And this of course works on a pro rata basis, like I said. Therefore, the reinsurer will receive the specified percentage, maybe 30%, of each dollar of premium, and will pay that same percentage if the loss happens. Meaning thereby, I decide as an insurance company that each and every motor policy that I seed out, 30% goes to the reinsurance company. The balance is retained by me, So like 70% is with me because it's a profit-making area for me. 30% I'm seeding out because losses could be there. So if the premium percentage seeded out is 30%, it is their responsibility to pay me back the same percentage of claims. So 30% of the claims will come back. If I seed out 50% of my premium, I get back 50% of the claims. Same percentage. The reinsurer will receive the stated percentage of each dollar of premiums and will pay that percentage of each dollar of losses. As simple as that. This is the pro rata, the proportional reinsurance that we have. Like I told you, it's an automatic reinsurance arrangement between the reinsured and the reinsurer. Now, why do I use the word reinsured? Because I use the word insured in the situation where I am the direct client to an insurance company. Here, the client is the insurance company itself. So therefore, the insurer is the reinsurer. So insured and an insurer, and a reinsured and a reinsurer. Therefore, the usage of the term reinsured and reinsurer. Once again, the reinsurer will automatically accept a certain liability for all risks falling within the scope of the agreement. Naturally, when the percentage has been decided and agreed upon, that is the percentage being ceded out, same percentage of claims should also come back. Now, the important thing here is that each and every insurance company will decide their own retention based upon the risk perception. Like I told you, fire is one area where the retention is high, surprisingly, across all insurance companies. Why? Because fire policies are less prone to claims as compared to a motor policy. So therefore, the fire premium, the insurers would like to retain more so that they do not lose out. So they retain more and cede out less. In motor, they retain less. Why? Because probability of a loss is high in motor. It's as high as 1 in 3 cars, almost 33%, 32, 33%. Whereas for fire, it could depend from insurance company to insurance company, where I know of certain insurance companies where the fire losses are as little as 10%. But then, one fire claims could absolutely skew the entire ratio and proportion of the losses that they have. That is why reinsurance and insurance is there. So the retention is basically the prerogative of the insurance company, and that is a choice that they make. When they decide upon the reinsurance philosophy, they have to identify and mention what exactly are their plans, why the reinsurance arrangement, how the reinsurance arrangement, and they specifically mention the thought process particularly leading to the retention, because this is one area which is approved by the board, and this reinsurance philosophy is sent beginning each and every financial year to the regulator. That's the importance of the RI philosophy. So the reinsured decides his retention on each risk and of course cedes the balance to the insurer. And of course the premium and losses are shared in the proportion that the reinsured's retention and reinsurer's share bear to the sum insured of the risk. This is typical, that pro rata kind of a thing. This is an example that I'm trying to give you for a quota share treaty. I told you, in this particular slide that I showed to you, that these are the kind of when it comes to a proportional and a non-proportional treaty, quota share is one of its kind, one of the ways of handling the treaty. And therefore, I'm just giving an example of a quota share. And like I told you, this is an automatic reinsurance arrangement wherein the reinsured cedes a fixed percentage of every risk. Okay, let us see how actually it works out, when we look at the numbers as such. So this is a 90% quota share, meaning thereby that the reinsured's retention is 10% and 90% is treaty cession. So if my sum insured is, for A case, is $100,000, and if it is 90% cession, the reinsurer will get $90,000, whereas the reinsured will retain $10,000. So when it comes to $200,000, the figure just doubles. The percentage remaining the same. Why? Because 90% quota share means 10% retention. Are we clear on this sum insured portion?
Yes, sir.
Similarly, when it comes to premium, so the premium is $1,000 US, 90% quota share, that means 90% the treaty will take it. So $900 US automatically goes to the reinsurer and $100 stays with me. Identical situation for claims. $20,000 US is the claim. So 10%, which is the net retention for the reinsured, and the balance 18,000 is the 90% cession. Now, if you will notice, you will see that whether it is the sum insured, whether it is the premium or the claims amount, the same percentage comes into play. And that is the most important aspect of this particular quota share treaty, which is a proportional kind, pro rata thing. So we say 90% goes to treaty, 10% stays with reinsured, and therefore, in all the three cases, if you see, you'll find that the same percentage of sharing happens, whether it is sum insured, premium, or claims. Are we clear on this?
Yes.
So we move to the, sorry, yeah, you had a question?
Yeah, I mean, it is just like this. If you look at the retention portion, as against a premium of 100, when there is a claim, you are shelling out how much? 2,000. So your ICR is pretty high on your net.
Okay, let us not get into that concept. This is basically to explain to you that the same percentage sharing happens, whether it is the sum insured premium or I got your, I absolutely got your point that you are trying to raise, but that was not my intention. Okay. The intention was purely to bring to you this particular situation wherein that the same percentage, whether it is the sum insured or the premium or the claims. So that is what I have tried to show. The point that you're trying to raise, I think we will discuss it offline, when you and I will have a discussion on that, because the point of ICR that you're raising will not hold good at this point. This is absolutely useless when it comes to an ICR. So we go to the second one now, surplus treaty. Again, automatic reinsurance, and the keyword here is the reinsured cedes the surplus over and above its retention on every risk, and of course the reinsured's retention is shown, the limit is shown in number of lines. So in this particular instance, we say, and this figure of 5% in red has been shown by me only for the sake of understanding that one line out of 20 lines is 5%. In fact, the moment this session is over, I would remove that 5%, 5%, because otherwise it gives a absolutely different impression altogether. So in this case, it's a 20-line surplus that we're talking about, and one line means $10,000 US. Now the sum insured, and ma'am, please let us not again talk about the ICR here also, because the purpose is not to talk about ICR. It's only about the actual figures that you see, and therefore you'll be able to appreciate it better as to what exactly is the surplus treaty all about. So if my net retention is one line, in this case, if I have my sum insured is 100,000 and it's a 20-line surplus, the 5%, which is $5,000 US, is with the reinsured, and the reinsurer takes 95,000. Similarly, when it comes to premium, out of $1,000, $50 is retained by the reinsured and $950 goes to the reinsurer. Similarly for the claims. Now, please understand there's one basic difference between quota share treaty and the surplus treaty. In this particular quota share treaty, which is one of the most common treaty policies, treaties that the reinsurers have, it's like a fixed percentage, so there's nothing to worry. My retention amount, this is my specified percentage, and across all lines of business, the balance will be seeded out. Here, we have to identify, and at a later stage, once we talk about the reinsurance arrangement, these lines of business assume a different connotation altogether when we also say that I have different layers of insurance cover. So, and I'm not going into that because right now the idea is to give you a brief introduction and whet your appetite so that you can ask questions on that. So this was the quota share treaty that we had, and this is the surplus treaty. Now, are we clear on these 2 points? Or else questions?
Fine, sir.
Okay. This is one of the most difficult portions, and I take a lot of pride in saying that Swiss Re, which is one of the leading reinsurers of the country, for the last 4 or 5 years, they have been taking students from BIMTech specifically to handle their accounts. I think last year they took 5. This year they have taken 4. And I mean, I can only assume that they are satisfied with the functioning and the talent of the students, because they come back to us every year for 4 or 5 students as such. There's another point that I wanted to share with you is that Swiss Re has an arrangement with BIMTech, wherein they come and teach our students the live cases and accounting process over a span of 18 hours. Their faculty members in 2018-19, the faculty members had come personally to the campus. They shared the details with the students. They took an examination after that. The last 2 years, they've had it on online basis. But the idea is that quality of education or learning that we have for reinsurance is definitely up to the mark, or else an organization like Swiss Re would not entertain us to this level. So from that perspective, when it comes to accounting, please understand this is the basis of the entire reinsurance arrangement. Why? Because at the end of the day, the number of transactions for underwriting that happen in a reinsurance company are so huge and humongous that it's practically impossible to keep a track of it. If that is so, think about the challenges that the accounts people would have when it actually comes to tracking the reinsurance accounting. Having said that, this is not 1995, wherein you have to do things manually. We have systems and processes that take care of these things as on a real-time basis. But believe me, even if the systems and processes are there, you need people to run it. You need people to verify it. You need people to actually command those machines to operate. And that is where the knowledge of reinsurance and reinsurance accounting, both of them, they help you in running these systems. So how does, because the reinsurance is typically like an insurance policy, So if I issue a policy on 1st of April 2020, my policy would expire on 31st of March 2020. Basically, one full accounting year. But what if I issue a policy on 31st of March 2020? Okay, 31st of March 2020, that means one financial year will end after 1 day. So that policy runs into 2 financial years. So how do we account for that? Can we say that one financial year ends and therefore that particular 1 day will be accounted in the previous financial year and the balance 364 days will be accounted in the next financial year? Or shall we say, okay, let this policy continue on a daily basis, so policy which was issued on 31st of March to 2020 will expire on 30th of March 2021. 1st April 2020 policy will expire on 31st March 2021. 2nd April policy will expire on 1st April 2021. So it's like a daily basis, We have an option there. There are 2 ways in which you can do it. One is we decide and say that, okay, the financial year comes to an end, period. So all the RI arrangement that I have had will end on, let's say, 31st of March 2021. But what happens to the policies that are actually still going on? Some of the policies maybe, you know, falling in the next financial year. There, what we say is that, and of course, the names that we give to them is that one is called the runoff treaty, meaning thereby that for one financial year period, it runs off. And the second is clean cut treaty, where we say that it continues, the policy keeps on going, you know, and you have a certain average amount, a percentage, whether it is for the premium entry or the premium withdrawal that we have decided. And these figures are not my figures. These are the generally accepted figures by the reinsurance companies based on the overall accounting process. So two ways in which we can handle the RI accounting. One is we say 31st of March, khatam, the policy ends, and the premium and losses are retrospectively accounted back to the year of that treaty arrangement. Why would someone like to do that? Because many a times the reinsurance companies, either they fold up, they wind up, or they go bankrupt. If that is so, the client, which is the reinsured, the insurance company, would be left high and dry. So the moment the financial year ends, all transactions are done, closed. Even if the reinsurance companies are not there after that, there's no worry, it has been taken care of. And the second, which we call a clean cut treaty, is that we continue, the premiums and losses are transferred. So if there are n numbers, let's say entire month of March 2020 policies, they will expire in 2021, February, isn't it? So for that 1 month of 2020, we will say the premium entry is 40% and the loss is 90% of outstanding. And similarly, for the balance 9 months, same percentage holds good. So what happens is that the reinsurance companies or the insured, they do not lose out upon it. It's a continuous process, you know, so like every month, every day, the policies are going on. And the biggest advantage is that the reinsured is assured that the policies are live. There is no question of a renewal per se, because it is assumed that all these policies will be renewed on its own, subject to, of course, payment of premium. But there is no formal notification coming that so-and-so policy is due for renewal. That is the advantage of having a clean-cut treaty. Normally, the reinsurers prefer the clean-cut treaty because it ensures continuity. We are aware of certain reinsurance companies winding up, but there are few and very, very few in number as such, until unless due to some regulations they are asked to wind up. So therefore, both the methods of accounting process are permissible and permitted, but it is the clean-cut treaty which finds favor amongst the reinsurers. Why? Because it ensures continuity. They are not worried that any of their policies will lapse. It keeps on going one after the other. Therefore, the importance of clean-cut treaty.
So this cannot be applied to facultative, right?
No, definitely not. Definitely not. This is absolutely for a proportional category, which is for the treaties as such. Therefore, I categorically use the word runoff treaty, clean-cut treaty.
You have a proportional arrangement under facultative also.
Yeah, we do have it, you know. In fact, we have a proportional and a non-proportional. But the question is that since these are isolated cases, these are identified individual cases. So you can tackle it any which way you prefer. Normally, even today, the reinsurers prefer the clean cut. Having said that, when it comes to facultative arrangement, which we will talk at a slightly different stage altogether, the accounting process is very, very easy and simple as compared to the treaties. Why? Because the volumes and the numbers are here. There, the quantum is large, but it's a 1 case, 2 case, probably 5 cases. You know, so there is one advantage that the facultative cases have when it comes to accounting process as such. When you come to the non-proportional, and again, I'm talking about treaties as such, the idea is that, and like we said, excess of loss kind of thing situation, because your losses have to exceed. Therefore, we say that this insurance responds when the loss suffered by the insurer exceeds a certain amount. Excess of loss is the kind of term that we use, So we say, okay, 5 million excess of 1 million. That kind of situation, So when your loss exceeds 1 million, up to a limit of 5 million, your claims would be reimbursed to you. Meaning thereby that 1 million excess is my kind of a retention thing, So when I say 5 million excess 1 million, I'm actually talking about 4 million, because that 1 million is my retention. We'll talk about that in details, and I think that is the example that I've given. Yeah, the same example, So I've tried to explain this concept of excess of loss treaty, wherein we say that the reinsurer is liable only when a loss exceeds the reinsured's retention limit. But here it is, 95,000 excess 5,000 each and every loss. So if the loss amount is 2,000 rupees, who bears what? And my excess and retention is $95,000, excess $5,000 for each and every loss. It is 5,000. Sorry.
So in this case, for the first one, shouldn't it be the reinsured who would be bearing all the loss, because since it's below the priority?
You see, what happened? There's another thing that I probably did not explain to you, and that is that all these accounting processes that happen, they are book adjustments. They don't physically happen in the sense that so much of money is transferred from this account to that account, and this reinsurer gives that money. It's almost, and I can safely use the term 99%. 99% is book transfer. Now, here what they are trying to specifically tell you is that even if that loss of 2,000 rupees was borne by the reinsured, a loss is a loss is a loss. So the reinsurer would make a note of it. Why? Because the claims history at the end of the reinsurer will not have that $2,000 loss. The excess will be absorbed by the client, the reinsured. That does not absolve the reinsurer of the responsibility that he should record the losses. So this is more of a book entry. However, the reinsurer keeps a track of the losses that have happened. And therefore, in both the situations, you will see whether it is $2,000 or $5,000, the reinsurer, both the places are mentioned as that. He doesn't pay, it is not his responsibility. This is kind of a retention, that 2,000 and 5,000, where because we use the term 95,000 excess 5,000. So excess is 5,000 for each and every loss. Up to that amount, the reinsurer is not liable to make any payment. It is automatically the reinsured's headache. However, when you come to the balance three figures, 30,000, 60,000, 110,000, you'll see the difference.
But sir, in the first two examples, why should the reinsurer keep it in his record? It is only to jack the price.
Actually speaking, the claims history as such.
It is not liability at all.
Not at all. Absolutely no. You're right. That's what I said. That the claims history is maintained, and obviously if the loss is not within the purview of the reinsurer, the reinsured would never communicate this, except that since it's a book transfer, book of accounts, all these informations are logged in at the end of the reinsurer. And tomorrow he'll come back to you saying, my God, you had so many losses, please increase the prices. And automatically it goes up. And this is the trick which is used by almost all the reinsurers, believe me. And therefore, when the RI philosophy is shared with these people, particularly the retention limits, you'll be surprised. And that was the point that you were also talking about when it came to policy excess and deductibles. The reinsurers make a note of all those things, that this was the policy excess, this was the deductible, etc. And therefore, n number of losses were there, which you were supposed to communicate to us, and it has come to us in the due course. We'll make a list of it. They do not pay a single naya paisa, they're not liable as such. But like you rightly said, they'll jack up the prices. And obviously, the client gets affected because of that. But if you look at the other two, 30,000 and 60,000, which are very clear. However, for the third one, $110,000, you'll notice that the limit is restricted to $100,000. And that is because the illustration that we have taken is for $100,000 only. So the balance $10,000 has to be borne by the reinsured himself. That will not reflect in this particular table because the restriction of $100,000 are here. Clear?
Yes, sir.
Good, thank you. Now, exactly the figures are here also here, except that what I've tried to show here is if it is a co-insurance, then what will be the liability and what is the ultimate net loss. However, if I can use the word, people with weak hearts should not do this, because people who are familiar with reinsurance terminologies, reinsurance accounting, reinsurance parlance, they would be able to appreciate it. Otherwise, it will be slightly difficult for them to comprehend as to if this is the typical excess of loss treaty. And again, you are giving me the same figures. Why this third slide is there? So this is just to give you a brief that if a co-insurance arrangement was there, the insurer will be liable only for a percentage of the excess loss. However, this particular net loss, ultimate net loss, has to be it will exceed the reinsured's retention policy. So except for probably one or two, the others can safely ignore this slide. No, that's not an issue. So what exactly is the meaning of the term retrocession? We talked about it. It is the reinsurance of the reinsurance companies. The reinsurance seller is called a retrocessionaires. The insurance buyer is called a retrocedent. And what are the ways to reinsurance? Pooled reinsurance, reciprocity, subsidies. From that perspective, reinsurance of reinsurance is a much simpler process as compared to a reinsurance of an insurance company. The simplest process is an insurance policy. I am the client, I go to the insurance company, a policy is done. Slightly complicated is the process because the insurance company goes to a reinsurance. But the most simple way is the reinsurance of reinsurance. They don't have to do anything. Simply pick up the book of accounts from that particular insurance company, place it in there, except that they'll jack up the price. So probably the insured paid, let's say, a brokerage of a commission of, let's say, 20% to the reinsurance company. The reinsurance company will pay 22% for retrocession. So 2% jacked up. Again, that retrocessionaire will go to another reinsurance company, maybe to another hike of 2%. I think 2% is slightly high because these people operate on percentage and decimals, because at that level, the volumes are so large that the amount is absolutely huge there. This is what we have for, when I was working on it, I thought of highlighting that at the end of the day, GIC Re is the most powerful one with this monogram that we have. Now, just a few comments on GIC Re before we go in for a question answer session as such. Let us not forget that GIC Re per se came into existence only after the private sector came into being. GIC as a national reinsurer was functioning since 1971-72, as it was also the holding company of the 4 government sector companies. The subsidiary companies were there, and of course the GIC asset management were there, things like this. The fact remains that I do not know how far it is true, but 2 years back or 3 years back, someone was telling me that GIC Re also had a share of business when it came to the Twin Towers of USA. Now, I have absolutely no way of ascertaining whether this is a fact or not, but I would not be surprised if GIC Re had a small percentage of share, because that was the particular year when GIC Re lost about 400 odd crores. And I think the total loss was 800 crores, if I remember correctly. So, could be probability is there. But if the probability is there, then that means GIC Re is literally going places, because providing a reinsurance cover for the Twin Towers, that means GIC Re has got some capabilities and capacity for reinsuring. So, however, I do not have any authentic information whether this is a fact or not. But what I was trying to tell you is that GIC Re has been expanding its footprint across the globe, and fairly successful measure, in the sense that they were able to handle business elsewhere, except that in Dubai the government came down heavily, saying that they would not permit it. However, in spite of the fact that the GIC Re office has been shut down for the last 3 months, our people from GIC Re are still there, because those live policies are still there. So the government doesn't have an option except to permit them to stay and service those policies. It is anybody's guess, as to how long these people can stay and work there. But at the end of the day, important thing is that as national reinsurance carrier, they have made their mark, and that is the importance of GIC Re. Few regulations that the IRDA mandates, like typically 5% of each policy has to be ceded to the reinsurance company. So when the reinsurance arrangements come into the picture, practically what they do is that for every 100 rupees of premium, 5 rupees goes to GIC Re. Post that, they say that, okay, 20% or maybe 20 rupees goes to the reinsurer, and in this case, it must be GIC Re again. And the balance 75 rupees is what is their retention. So the other way in which the quality business comes to GIC Re is through this mandatory 5% cession of each and every policy. And then, of course, there are intercompany cessions between the 4 public sector companies. The first right of refusal is with GIC Re. Then the other reinsurance companies can be given the offer. And of course, there are still pressure groups working with the government to ensure that this particular clause be removed. The government is not in a mood, for the simple reason that this first right of refusal gives it some sort of a authority and a power to emphasize and show the people that this is the national reinsurer and we have a right to have the first right of business as such. Then, of course, typically there's nothing much there. If we have any questions, I'm right now open to it.
So this intercession which you're talking about between companies, that is not existing anymore since last year. I think they've called it off, at least in marine.
You are absolutely correct, and that is precisely why I did not read it out, because I realized this was the statement which should not have been there, But I remember sometime in 2006-07, we had a very fruitful relationship with people in the Middle East, and there were ways of circumventing the law, and we used to say inward RI transaction, So we did a lot of business under that clause of inward RI. Actually speaking, had I been in the place of GIC Re, I would have charged the insurance companies of having violated the law. But as long as it was making money, everyone was happy about it. And that is the biggest challenge that we face when it comes to reinsurance, And why only reinsurance? I mean, any other such regulation, till such time all is well, nobody bothers about it, till something goes wrong. And then in retrospect, we discover that, oh my God, 50 years back, things were going this way. That is the biggest challenge that we have had with reinsurance till now. The only positive thing that I can tell you is that in the last probably 4, 5 or 6 years, a lot of introspection is being done by GIC Re, and obviously some people may not like it, but fact remains that certain remedial steps are also being taken. But it's still too early, I should say, because a humongous organization like GIC Re needs a lot of introspection as such. But having said that, the idea is that we are no less than any other reinsurer in the world. We may be very short as far as the age span is concerned, but the kind of expertise, the kind of experience, the quality and the capability of the people, beyond par. There's no doubt.
Just one more question, sir. Is there any regulation which stops the direct insurance companies from approaching the reinsurers without an RI broker? We cannot approach the reinsurers directly?
Honestly speaking, this particular issue and the second issue, there's another one, two specific topics being discussed. One is that why cannot the insurance company, when we say interaction between insurance companies and reinsurance companies, why cannot an insurance company interact with another reinsurance company, keeping GIC Re in the loop, because they have the first right of refusal. But what if the insurance company gives me a rate which is lower than GIC Re? So the GIC Re offers me, let's say, a rate of, let's say, 45 paisa, and AXA Re gives me a rate of 40 paisa. What do I do? Because the regulation says that the first right of refusal is with GIC Re. Point noted, agreed and accepted. But I am seeing my money going down the drain there. At that time, should it not be made mandated upon the GIC Re to reduce the rate from 45 to 40? Why? Because there is a reinsurer willing to do that. Now, there is no regulation there. Similarly, the point that you've raised is still a gray area. Now, problem is that now people are raising these questions more frequently than used to happen about 10 years back. Why? Because now everything is more under scrutiny, more under pressure. People are there because the margins have actually gone down. So now each and every single paisa makes a lot of impact. And therefore, the question that you raise is absolutely valid. The gray area is now being questioned. And therefore, I told you that the second issue there is that now people are asking questions to why shouldn't GIC Re be asked to reduce the rates when there is a office of a reinsurance company in India who are willing to reduce the price.
Sir, can I?
Sure, please.
Sir, the reinsurance regulation in India, the IRDA, says not more than 10% of reinsurance premium to be placed with one reinsurer. In that case, almost as if, suppose if GIC retains 10 or 20%, rest 80% means 8 reinsurers need to be placed with. Am I right in understanding that?
Theoretically, yes. Theoretically, you are absolutely correct that this is the situation. Normally, what GIC Re does is that the domestic risks are normally covered by GIC Re up to the level of almost 50%. Now, this is not a written law as such, except that by and large, the risks that we have are better risks as compared to the foreign reinsurers, and therefore, GIC Re being the lead reinsurer here, they normally 40% to minimum rehta hai, 40% to sure shot, don't worry about it. But in certain cases, it goes beyond 40% also. Effectively, what happens is that there are 2 or 3 reinsurers involved in it. Now, suddenly, because of this, the market actually expanding and a lot of technological advancements, particularly for as far as risk modeling is concerned, there are certain issues being raised on the points where the reinsurers say that we are willing to cover at a lesser price and better covers. That has brought the GIC Re into a lot of focus and a lot of pressure. So, but yes, theoretically, you are absolutely correct that not more than 10% should go to a single reinsurer in the private sector.
So even if the example just you cited, suppose GIC Re retains 50%, but still that cap of 10% will remain for the rest of the other 5 insurers.
Yeah, and I'll also tell you there are ways and means of circumventing the law that these reinsurers do. Many a times what happens is then there is a conglomeration, a group of reinsurers, and they'll all gang up, and look, this group has probably 20 reinsurers. So they will offer the rate that, okay, fine, we are willing to take 10%, each. But they're all, I mean, honestly speaking, we shouldn't even be talking about it because that is against the regulations. But this is the harsh reality that we have in the market.
Yes, and there might be some participant from reinsurance companies also.
So,
but still, the matter is for discussion. I think everyone should reintrospect that part.
No, Mr. Iyer, I mean, honestly, if I were working for an organization where, the organization is involved in such things, I'd rather keep quiet, for the simple reason that I would not like to be a whistleblower, jobs are scarce. And jobs in a reinsurance company, my God, it's a dream job that people are talking about. And honestly speaking, my question would be, I'm not the one who's doing it. Little realizing that I'm a part of the entire system. I mean,
they are in the industry of risk.
Oh yeah. This is the thought process that most of us have. The problem is that had this not been the case, the number of whistleblowers in our company would have been 50% of the total population. All of us know what's going on in the industry. All of us know what's going on in the society. We all know who the crooks are. But then that's how life is. That's the biggest challenge. People don't find witnesses to incidents that has happened in front of 10,000 people. What else can we talk about? That is life.
Mm-hmm.
Sir, could you throw light on the excess of loss, types of excess of loss treaties?
Ms. Iyer, honestly, I did not go into the details because I personally felt that this was more of an introduction session.
Okay,
but if you permit, if you have my email ID, and if you could just send me a reminder mail, I'll share with you my presentation on specifically on excess of loss treaties. I have it with me. That's not an issue, because
yes,
we teach the students also these things, and our interactions with Swiss Re are also there. So please put in an email to me. I'll definitely share it with you. That's not an issue.
Sure, sir. Thank you, sir.
Right.
Sir, I have one question.
Yeah, please.
Yeah, this is regarding the reinsurance accounting, which you shared just now, the slide. Okay, so the runoff treaty, I was confused regarding this word, because once I have gone through some article, I believe the runoff treaty is when the insurance company is about to merge with another company, or they are about to close. So they use this. Yeah.
No.
They use this.
I specifically, if you remember that slide, I had put in 2 asterisk marks there. And that was just to ensure that normally this treaty is helpful even when the reinsurance companies wind up. Because what they have already handed over, whatever communications, whatever accounting process, systems, documents that they have had. So this treaty helps in those situations when the reinsurer is either shut out, he goes out of market, or whatever happens, So there's the reinsured is taken care of. And I think I specifically mentioned this when I was talking about my presentation.
Okay, so there's one more question.
So what you said was absolutely correct. And that policy is there to ensure that the reinsured does not suffer in case the reinsurance company winds up, or it merges with some other organization, things like this.
Yes. Sir, can you just tell a short about burning cost, how it is calculated in non-proportional treaties, and what is the basis on this one, please?
Okay, let me start with the computation of burning cost for a simple insurance product. Fine. Motor insurance. We start off with the simple cost of the policy per se, because when we are filing for the product, we prepare a list, and therein we say that the cost of the policy, the cost of the risk to be covered, the risk premium that we say is, let's say, X rupees. And then post that, we add certain more factors to it, including factors like cost of acquisition, including factors like office expenses, and certain bit of profit also. Now, this is what we say, that this is the cost of the risk, and the balance are the other factors. This is for a simple product when we talk about an insurance company. However, when it comes to a reinsurance companies, the list of payments, particularly commissions, there are 3, 4, 5 different categories of commissions. I don't know whether, no, I right now I don't have it, because I had a presentation with me on that particular subject also. So what happens is that there are 4 or 5 or 6 different categories of commissions that come into the picture, Therefore, when you are pricing it, we must know the background in which this non-proportional treaty was functioning. What was the line of business? What was the profitability, loss statement, and the relationship with the insurance company per se, that the reinsured. So all these factors would actually help and identify, because when it comes to the burning cost per se, all these factors will add up. There are many a times when the payout goes as high as 50%. Why? Because there are 3, 4, 5 different categories, based on performance, based on quantum, based on profitability, based on loss ratios. So the reason why I'm not going in specifically into those things is that right now I don't have my presentation or the slide with me. Maybe some other time, as and when we have an interaction, I'll share that also with you. It's always better that you have the background of the reinsured with the specific data before computing this. So that is why I give you the example of the pure risk premium when it comes to a simple product in insurance company. However, when it comes to reinsurance, particularly non-proportional, there would at least 5 or 6 or 7 different parameters would be added up. The cost goes up.
Thank you.
Right.
So I think there are no more questions. So we will wind it up today. So thank you, Pratik ji, for a nice session. And I think we will request you to have some more advanced session on other topics. So we will have it in future, and also we will try to conduct some webinars to discuss more engaging issues on reinsurance. So for today, I think we are done. So thanks a lot, Pratik ji, and all attendees.
Thank you, sir. Thanks a lot.
Yeah,
it has been very enlightening.
Yeah.
Honestly, Rakesh ji, I'm grateful to you that you put me across these people who had questions to ask. Honestly speaking, this is the situation where people don't ask questions. They may be having a lot of questions with them, but somehow, either because of sheer inertia or sheer inaction, nobody asks question. But I'm so glad and I'm grateful that at least people asked questions, and relevant questions at that. That's the most important thing. I had not expected that this session was just a simple introduction, because the kind of questions that have come up definitely show that people have gone beyond that normal introduction. Probably we should have gone to the next level and have had this session. But thank you very much, and I'm grateful to you and to the participants.
No, actually, we will be having those sessions just since it was an introduction. So we thought of starting from this, and going forward, we will be having those sessions. And I think
look forward to that. Huh?
Yeah. Sure. And I think we had this webinar on reinsurance last year.
Rakesh ji, please remember, you were the first one to start off this post-pandemic.
Yes,
that was the